Today on the Purpose-Based Retirement, 4 questions you need to ask before buying an annuity and how we helped one couple make minor changes to their Social Security plan to dramatically increase their chances of success during retirement. Stay tuned.
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you face, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. My name is Lee Kelso. I am here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're going to be diving in today to the 4 main types of annuities. And I'm calling this segment Annuity University, Casey. I think we're going to cover a lot of the questions that people need to be asking.
Well, I love the Annuity University. I think that's a great way of saying it, because I think most folks either have a preconceived notion, or even advisors have this notion that annuities are just bad altogether and we shouldn't even evaluate them, but we should be educating ourselves in a university fashion no matter what the product is, whether it's stocks, bonds, mutual funds, ETFs, long-term care coverage, life insurance. I mean, whatever the tool, we need to understand that tool, especially as we step into retirement, because you've accumulated these assets your whole life. It didn't get there overnight. It probably took you 20 years. It probably took you 40 years to get to where you're at today. And without understanding everything that's out there, how can you make sure you're making the best decision? To go 30 or 40 years of saving and accumulating this asset and making a decision in 10 minutes or 2 hours even makes me pretty uncomfortable. And that's why when folks come into our office, we have a step-by-step process. I know some advisors pride themselves on, hey, our meeting's never going to last more than a half an hour, but I'm perfectly fine our meetings lasting an hour and a half or in 2 hours. I've got some of the best relationships I've ever created. Took me 6 to 8 meetings of diving in deep to all the different tools that are out there, how they could be structured, and what best plan to put together. And now those people go out and they tell all their friends, because they know exactly what they have, and nobody else was willing to put in the time and effort to make sure they could be that comfortable as they stepped into retirement. And there's never a more important time to educate yourself on retirement than when you step into it.
Absolutely. So we're going to start this segment with some information that you can find online, and this is Casey's most recent article. He writes for Kiplinger Magazine, Forbes, and other places from time to time, but this is the article that we're going to be pulling the information out of. You can always go to the Howard Bailey Financial website or the Purpose-Based Retirement website. Look for the Read tab and you'll find this and other articles
Just
there.
hop on howardbailey.com, click on Read, and you can read all those past articles.
All right, so let's jump right in with the type of annuity that I think a lot of people are kind of curious about, and that is an immediate annuity. Now, that makes it sound like I'm going to start seeing money right away.
Right. Well, that's really what it means. And it's, this is one of the 4 questions you should be asking before adding an annuity is, well, which one's right for me? Because there are a lot of different types of annuities out there today. And I think we've kind of got this idea that they're all the same, right? That, well, one annuity is all annuities, and most people know annuities as immediate annuities, something where I lose control over my life savings. I get income for the rest of my life, but it's kind of like long-term care. Use it or lose it, right? I either use it, that income, or I end up losing my principal because the insurance company keeps it. And that is how an immediate annuity works. You get a guaranteed income stream for the rest of your life that you can't outlive. Now, for most people, I would say this probably isn't the best vehicle, especially in the interest rate environment we're in today. You're locking yourself into this interest rate environment for the rest of your life. Maybe it's okay to do that for 5 or 10 years at a time, but to go for the rest of a lifetime, maybe 20, 30 plus years, that's very concerning. However, immediate annuities don't have to be annuitized over an entire lifetime. They can be done over shorter periods. Those are period certain immediate annuities, 5, 10 years at a time. For instance, I've got a gentleman who, when they came to visit, they had a lot of different types of assets, but they they had an old variable annuity that they had had for years. The variable annuity had fees over 3% a year after you included the mutual fund fees, the death benefit fees, and everything that was wrapped in there, admin charges, etc. So they were paying a lot in fees and expenses, and they still had gains that had built up in there. They had a substantial amount of tax liability that if they were to take it out in a lump sum, they'd be taxed on all that gain, or if they even took withdrawals. It's taxed as last in, first out, so they end up being taxed on their gains first as they're taking withdrawals. We were able to use that as part of their first leg of income. We annuitized it over 10 years. We had to transfer it to a different carrier in order to get the best rate, and then that allowed us to spread those gains out over 10 years and satisfy their first 10 years worth of retirement income. That gave them peace of mind to know that they had income guaranteed and they could continue to take more risk with the remaining assets, and it allowed us to minimize their tax liability at the same time. So there are places where this may be a good idea, but I'd say for the majority of people that are stepping into retirement, probably not.
Okay, so that's an immediate annuity. The next one is a fixed annuity, and this one I understand feels and behaves a lot like a CD.
It does without the FDIC coverage. It's backed by the claims paying liability of the insurance company itself, but it operates a lot like a CD from a crediting perspective and a term perspective. You're going to get an account that typically has somewhere between 3 and 10-year term, right? So 3, 5, 6, 7, 8, 9, 10. The longer term that you take, the more interest you're guaranteed. It gives you a fixed rate of interest, guaranteed to credit interest every single month, or typically monthly, sometimes annually. And that is something that not everybody needs or wants, for that matter. But for some that want a fixed rate of return every month, I've got a gentleman who's a farmer that had sold a part of his farm, invested in the market, ended up losing a good portion of it. And when he came to see me, he said, I never want to lose money again. He said, I want to make interest every single month. I want to get a monthly statement that shows that I have a gain in my account. Well, there's not too many ways to do that other than a CD or maybe a treasury, something that's insured and backed. So he used a fixed annuity that guaranteed him 3.5% over a 5-year term, and every single month he credits interest, and he loves it. That's what he wanted. He didn't need to make 4 or 5%, and he was fine with making 3 or 4 and knowing he was never going to lose. He draws the interest out of it every single month, and he continues to sell pieces of the farm and buy more of these things because it gives him exactly what he wanted. Now, a 30-year-old that's got 30 years till retirement, probably not the best place to dollar cost average.
Yeah. So this one, the indexed annuity, is, however, pretty flexible and I think growing in popularity.
Right. We're seeing a lot more in fixed index annuity sales today, especially if you look at that in comparison to variable annuities. There's a month in 2016 where we actually saw variable annuity sales drop 25%, while index annuity sales popped 30%. And we're seeing more of that every single year. These vehicles offer you principal protection and some type of participation in the stock market itself. And for myself, it was a good fit. It was a good place for us to put some of our excess cash because I was a little skeptical about the market. Gave them the ability to participate in the market gains if I was wrong, and still have flexibility if I was right and the market was down. I could move money back into the markets if I wanted to over time, if not in a lump sum, depending on the structure of that account.
And the bad boy of annuities is this guy, the variable annuity.
Right. The variable annuity is typically known as the bad boy of the annuity world because of the high fees and expenses. This is where you're going to hear Clark Howard, Susie Orman, say never put your money in an annuity. They're talking about a variable annuity, and because most of these variable annuities are sold with mutual funds and an IRA going into this variable annuity that gives you a tax-deferred vehicle, but you're invested in mutual funds, and you have to pay a fee for that tax-deferred structure that's sheltering it from ongoing taxation, when you'd probably be better off if you just bought the mutual funds without that annuity wrapper and reduced your fees and expenses. I've seen fees and expenses in excess of not just 3%, but 4.5%, 5%, per year inside of these accounts. However, that doesn't necessarily make them all bad either. I had a gentleman that came to us once who had a non-qualified variable annuity that he had owned for years. So it wasn't an IRA, it was non-qualified money. He was making $500,000 a year, so he was in the top marginal tax brackets. And so because of the amount of taxes he was having to pay each year, it paid to have that tax deferral. However, he was paying really high fees on his old variable annuity. He wanted to reduce those. We moved those over to a lower cost variable annuity where he'd only pay pay $20 a month. So he paid $20 a month, and he had over 350 different investment options, index funds, low-cost index funds. So he was able to maintain that tax deferral benefit at a fraction of the cost that he had before. And for some, and I would put this in the bucket as the immediate annuity, for some, very few, this might be a good option. But for most individuals, a fixed or fixed index annuity comes into play today because it acts as a good bond alternative without the default risk and the interest rate risk.
We're going to continue our look at annuities here in just a second. We're going to show you the pros and some of the cons of annuities. So if it's in your future, and we certainly hope retirement planning is, stay with us. We'll be right back.
Today, Casey is making this very special offer, a consultation with Casey. Are you prepared to stand up to retirement's most significant threats? Find out. It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and potentially increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get better answers from Casey's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Casey himself put you on the path to your very own purpose-based retirement.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
So before the break, we just mentioned how significant index annuities have become in the market. There are lots of people are supporting them these days. So we want to dig a little deeper here. Let's look at the negatives and then the pros of indexed annuities. So let's jump right into that.
Sure. Well, let's start with the negatives. I think that's always appropriate to start with the downside of these vehicles. And when we look at the downside of fixed index annuities, I want to do this first also because you only hear about the pros when you turn on the TV or the radio. So let's do something different and talk about the downside of these things. And the first thing is that you're probably going to earn less than what you would earn if you invested directly in the stock market, like investing in the S&P 500. Now, I'm also going to say that the average mutual fund isn't getting 100% of the market's gains, might only be getting 50 or 60% of the market's gains. You may be able to get that in an indexed annuity, but on average, we like to say we're going to expect, say, 3 to 6% with a good indexed annuity, maybe 6 to 10% with a good, actively managed investment portfolio. Another one of the downsides is liquidity. You have limited withdrawal privileges, so you may only be able to take 5 or 10% of your account value out of this account every single year. Now, some people think that we can't take anything out of an annuity. The reality is that you can. You have a certain withdrawal privilege that you can take every single year at 5 to 10%. But if you draw over that, that's where these penalties come into play. There can be penalties that are high as 15 or 20% of your principal in the first few years. Typically, these penalties start at, say, the term of the account. So it's 5 years, they'll start at 5 and go down by 1% per year. Okay. But for some companies, if they're offering you a lot better benefit, those penalties may be substantially higher, because if you look at one company that's going to give you 60% of the market's gains and another one that's only going to give you 20%, the one with 60% of the market's gains probably has substantially higher penalties than the other. The other one is, lastly, and this is what a lot of people complain about, are the terms. They don't want to be tied down. And I've heard brokers give this. They'll say, well, I don't want to tie your money up for 5 years or 10 years or 15 years, and then they'll turn around and they'll buy a 10, 20, 15-year bond or more. I've seen people walk into our offices owning 20-year plus bonds today, 20, 25-year bond terms, just so they can get 5 or 6% in an investment-grade bond. I don't care if a company is an investment-grade company today. 20 years from now, things can change.
Who knows, right?
Yeah.
And what is that bond doing? It's insuring you against some downside, and that's exactly what this indexed annuity does. So let's go to the benefits. They typically perform a little better than other tools.
Right. If we compare them to, say, other fixed products that are backed by some type of legal reserve system, say a CD or even an investment-grade insured bond or a treasury for that matter, products of similar term, we typically see higher rates of return or relative potential with an indexed annuity over those other things. And your principal's protected. So you're getting market participation and greater growth potential, and your principal's protected, like you might find with other vehicles that are backed by some type of legal reserve system. And also you might be able to add benefits like long-term care benefits or death benefits that you may not otherwise be able to qualify for. I had a gentleman just the other day who is 70 years old and had previously had a heart attack and cancer. And he was never going to be able to qualify for long-term care coverage. It was a major concern of theirs. So we were able to utilize an annuity to pick up long-term care benefits that they couldn't qualify for otherwise. And not only do they have long-term care benefits, but they've got a place so their funds are going to grow over time. And if they never use them, they pass on to their heirs in the way of a death benefit. And lastly, we have guaranteed lifetime income. Right? So we can pick up a rider that gives us a guaranteed income that we cannot outlive. We're going to have this income for the rest of our lives, and there's only one type of product that can do that, and that is an annuity. And we also get tax deferral as a bonus. I say that, kind of pro con, let's see. For some that are in very high tax brackets, probably a pro, but for the average individual, tax deferral is probably not that great a thing. They might be better off investing in traditional investments that offer long-term capital gain structures. But in comparison to a CD where I'm going to pay taxes on that every year, in ordinary income taxes, I'd rather have tax deferral inside of an indexed annuity for that matter.
All right, so let's go into summary mode here and let's head to the chalkboard so we can total it all up, so to speak. And that is, how can I be sure I'm getting the most for my money?
Well, the first thing you have to do is you have to work with an independent advisor because these rates are all over the board, and most of these captive companies are really founded as brokerage firms. So you might find one company, for instance, I had somebody that came from a major brokerage firm. They had a 10-year fixed annuity paying 2.5%. At the same time, we could have got them 3.5% with a highly rated company, but that's just due to our independence versus the captive. Also make sure if you're sitting down with an advisor discussing annuity, you understand why they're offering you that annuity in the first place, and what they have to do is show you a few different types, right? And not only show you a few different types, but say, this is why we chose this one because of this, this, and this. Look at these 2 or 3 different options. Now you know why you're getting the one that you're getting. I think there's some other things that we need to think about and ask ourselves before we buy an annuity. That is, what are the fees and expenses? And I think one of the most important things is how strong is the issuing company? What's the credit rating? You can look at S&P, you can look at Moody's, AM Best, or even better yet, Comdex offers a great ranking percentile to give you the best idea of how strong that company really is. I think we need to take all these things into consideration, and ultimately how much is the right thing how much should we be allocating to that annuity, because it shouldn't be our entire portfolios.
Right.
And why are we doing that percentage? Why 10%? Why 90%? Why 80%? Because there should be a reason behind every single decision you make when you're making an investment and allocation that's going to impact your retirement for the rest of your life.
So don't be too swayed by what you hear from Susie Orman and even Dave Ramsey sometimes badmouths annuities. The right annuity in the right place for the right reason has a good fit. All right, let's take a look at the question of the day, and it has to do with Social Security benefits, something that matters a heck of a lot to all of us. What is the Social Security cost of living adjustment for 2018? We have the answer coming up.
Today, Casey is making this very special offer, a consultation with Casey. Are you prepared to stand up to retirement's most significant threats? Find out. It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and potentially increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get better answers from Casey's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Casey himself put you on the path to your very own purpose-based retirement.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
Let's see how you did with our question of the day. It had to deal with Social Security benefit increases. What is the Social Security cost of living adjustment for 2018? Which one of those is correct?
Well, Lee, you might be surprised. It's actually all the way up to 2% now. So we actually saw a cost of living adjustment for 2% for Medicare or for Social Security enrollees. The 66 million Americans that are drawing on Social Security have now seen an increase of 2% over last years. And you know, a lot of individuals are very pessimistic about Social Security cost of living adjustments. I have a lot of couples that'll come into my office these days and they say, I don't want to use any cost of living adjustments, or I want to use 1%, or I want to use 0.5%. And quite often it is, I don't want to see any cost of living adjustments projected into my future plan. The thing is, the 40-year average of Social Security cost of living adjustments is almost 4%. And if we look at the last 10 years, it's over 1.5%. It's just the last 2 years we haven't seen much increase. We saw 0.3% and no increase in the previous year, and that had many individuals being kind of pessimistic. However, we're starting to see inflation pick up a little bit. And if we see inflation pick up, we're going to start seeing some larger cost of living adjustments in the future. And I sure hope we do, because a 2% raise is a pretty big deal for many retirees that rely on Social Security as not just a major source of income, but many of those retirees that are out there today rely on it for their sole source of income, believe it or not. And retirement's really made up of these three most important areas. It's made up of Social Security. It's made up of employer-sponsored retirement plans. It's made up of your retirement savings accounts. And what we need to do is analyze each one of these things and see them as one piece of the puzzle. Your retirement savings account, we need to make sure that we're allocated in the most diversified way to provide you with the most consistent and reliable income that we can from that diversified investment portfolio. When it comes to your employer-sponsored plans or even income-producing products, you want to make sure you're choosing the best pension option. Is it the joint and survivor option? Is it 50% to my survivor? Is it a 10-year period certain option? Or what about Social Security for that matter? When it comes to Social Security, you need to be analyzing all those different ways that you can draw those benefits. However, unfortunately, most of the time we're just signing up for those benefits and not evaluating what might be the most optimal way for us to draw on those benefits during our retirement years. And all these things have to come together in order to create a truly comprehensive plan that can give you the confidence to spend your dollars during retirement, and it can have a huge impact. And I want to show you exactly how by utilizing an example. We're going to talk about John and Jane to protect their identities. John has a $2,500 a month Social Security full retirement age benefit. He's currently 61 years old. Jane is 62. Now, Jane's full retirement benefit is $1,185, about $1,200 a month, and her full retirement age is 66 and 4 months. So your full retirement age is 100% based on your age that you were born, and that's what determines what your full retirement amount is. Both assume that they would begin drawing those benefits at their full retirement age, which is very typical of retirees. And you have to ask yourself, well, why is that? Why am I drawing it at my full retirement age? Is it just because it says it's my full retirement age and that makes the most sense? Well, in reality, if we wait one more year, we're going to get about 8% more in benefits. If we wait till 70, that's when we get our full benefit, not at our full retirement age. So that's not always the most optimal time to do it, just because that's what it says on your statement. In addition, John has $850,000 in his 401k and $350,000 in a joint account, and they're invested in that old 60-40 playbook. They've got a balanced portfolio of 60% equities and 40% stocks, and they need $6,000 a month after taxes to support their retirement lifestyle, $72,000 a year. The next thing we needed to make sure we were paying attention to is their life expectancy, which is important in all these decisions, whether it comes to your retirement savings, your employer-sponsored pension plans, or even the way that we structure Social Security. We need to figure out what our life expectancy is. John said 85, Jane said age 90. We ran all this information through our analysis software, sharing with them that on their current course with a 60-40 portfolio, they would have, with needing $6,000 a month in income, including their Social Security benefits, they would be filling that gap with their investment portfolio. They had a 65% chance of success during their retirement years. Their average shortfall age would be 89, with an average shortfall of over $500,000. Now, if the market performed really well, that'd be in the top 10th percentile or the top 90th percentile of historical market returns on those stocks and bonds, they would leave behind $4 million and have all the income they need during their retirement years. On average, they would be left with around $500,000, but in the bottom 10th percentile of market returns, which could happen if we're stepping into retirement in an overvalued market or an expensive market, they would be left with a shortfall of about what they have today, about $800,000. So the first thing we wanted to do was optimize their Social Security benefits. We ran our Social Security analysis through our software, plugged those numbers in, and just by tweaking their Social Security benefit, we were able to increase their probability of success from 65% all the way to almost 80% chance of success just by changing the way they were filing for Social Security. That brought the top percentile of market performance, added about another $500,000 to their bottom line, and took that bottom 10th percentile of market returns, leaving them with only, say, a negative $900,000. Now they've got a negative $400,000. What we wanted to do next was optimize their portfolio, because this is a puzzle, right? So after we optimized their portfolio, realizing that there's more out there than just stocks and bonds, in order to protect our retirement and grow our income into the future, we were able to increase their probability of success all the way to 97%. And now we can see even in the bottom 10th percentile of market performance, they're still left with positive returns. And if we see that bottom percentile or that top percentile at 90th percentile, we dropped their growth potential because we reduced their overall risk. And they said, that's okay. We're still leaving behind more than we have today. We don't need to leave behind an extra $1 million. We just want to know that our money is going to be there for the rest of our life, regardless of what happens in the market. So we took them from a 65% chance of success on their current strategy to 79% by optimizing their Social Security benefits. Then we optimized their portfolio along with their Social Security, so those things were matched up, increasing their probability of success in retirement all the way to 97%. So here's some things to remember. I hope you take away that filing for Social Security can be more complex than you first thought. You shouldn't just walk in and file. It is a part of the puzzle, and a lot of factors come into play. Your marital status, your health, your longevity, your retirement savings, and you have to consider all these things, including taxation, before you make that decision. Social Security is one piece of a three-legged stool. Your retirement savings, your employer-sponsored retirement plans. We have to take all these things into consideration in order to give you the income that you really need and deserve during your retirement years. A lot of folks just focus on Social Security planning. They go out and they get a Social Security analysis and they don't plug it into the big picture, or they do their investment planning and then they go out and they file for Social Security. We have to make sure they're all coming together so that we can get a good picture of what our probability of success really is and increase that like we all want to.
To 97%, that is a home run. That's outstanding. We are out of time, but if you'd like to have more information, you can always go to thepurposebasedretirement.com. You'll be able to find lots of information there, copies of Casey's books, and even watch episodes of this program. We'll see you next week. Take good care of yourselves.
Today, Casey is making this very special offer, a consultation with Casey. Are you prepared to stand up to retirement's most significant threats? Find out. It's a comprehensive education about your money, and your consultation is complimentary. See what you really pay your current advisor. Optimize tax savings and potentially increase your cash flow. Get more benefit from your benefit. Learn proven wealth strategies and techniques to help you feel more secure. Spend in retirement with confidence. Eliminate guesswork. Get better answers from Casey's fact-based approach. Make better decisions. Meet your financial objectives. Rise to your financial challenges. Call the number on your screen right now. Make your appointment. Let Casey himself put you on the path to your very own purpose-based retirement.